The live price for Opendoor Technologies, Inc., trading under the ticker OPEN, is sitting at $7.97 as of the last update during the trading day on November 10, 2025, reflecting a powerful intraday move of approximately 21.04%. This massive daily surge immediately cuts against the grain of the widely held narrative that Open is simply a volatile, broken, eye-buying model stock doomed by rising interest rates and a frozen housing market. The market is telling a different story, and it's less about the macro real estate environment and more about what the company is actually doing internally right now, and how that is playing directly into the hands of a massive and highly engaged short-selling crowd. The sheer velocity of this $1.41 upward swing on a volume of over 215 million shares is not a quiet institutional buy-up or a modest reaction to an analyst upgrade. It is the sound of a very painful, very public short squeeze scenario being executed in real time, exacerbated by recent corporate moves and a deeply polarized investor base. The general expectation in professional circles, especially following the recent Q3 2025 earnings report, was that Opendoor would continue to bleed cash and that the stock would drift lower as the housing cycle remains challenging. Their Q3 results did in fact feature a wider-than-anticipated net loss of $90 million and revenue that missed analyst consensus, which is the reality the street was focused on. The stock initially tumbled almost 15% in after-hours trading on that news. But here's the unexpected twist. That massive initial earnings drop created a perfect pressure cooker for a short-term reversal, as the new CEO immediately reframed the poor quarter not as a cyclical defeat, but as a strategic pivot. The market narrative, the general belief, has long been that Opendoor is a real estate company with a little tech on the side, meaning its fortunes are entirely tethered to mortgage rates and inventory levels. This current price action challenges that deeply ingrained belief because the stock has violently decoupled from its immediate fundamentals. The reality that is catching short sellers off guard is the management's sudden, aggressive commitment to an Opendoor 2.0 vision, where they claim to be refounding the business as a pure software and artificial intelligence company that happens to operate in real estate, complete with over a dozen new AI-powered features launched in a single quarter, and a highly public, almost performative break from the past, including an end to consultant reliance. This is exactly the kind of new story catalyst that forces a reevaluation, especially when combined with a dangerously high short interest figure, which most recently sat at over 25% of the float, or around 161 million shares sold short. Looking at the technicals and the institutional flow from the last few trading days, this volatility is palpable. Following the Q3 earnings, where the company announced the strategic pivot alongside the financial miss, trading volume spiked dramatically. On the day after earnings, the volume exploded to over 214 million shares, far exceeding the three-month average, and a significant portion of that was initial panic selling but quickly morphed into aggressive short covering and momentum buying. The previous 2 weeks saw the stock trade in a tight range, essentially building up pressure between $5.50 and $7.50 before the earnings announcement pushed it below that range, only to see it snap back with this current dizzying upward move. Institutional activity has been mixed, which only adds to the tension. While some major institutions like BlackRock and Vanguard have been reducing their positions over recent quarters, signaling traditional caution about the eye-buying model's vulnerability, newer entrants and quantitative firms like Two Sigma Advisors and Cube Research have been aggressively adding shares. This creates a fascinating tug-of-war where old guard institutions were bearish on the old model, but the fast money is now jumping on the new CEO, new AI story, combined with the obvious short squeeze potential. This daily swing is a direct manifestation of these two forces colliding, the smart, fundamental money exiting versus the high volatility technical money piling in. The retail investment community, particularly on platforms like X and Reddit's Wall Street Bets, is a primary driver of this current surge, and their sentiment is a crucial, non-fundamental factor here. For months, retail investors have felt frustrated and even outright hostile toward Opendoor's decline, frequently citing what they perceive as intentional manipulation or media bias against the iBuying concept, especially as they watched the stock price flirt with the $1 NASDAQ delisting warning earlier this year, before its massive run-up from the $0.51 52-week low. The feeling was that the stock was unfairly held down by high short interest and analyst price targets like the $1 and 0.7 cent targets seen recently that seemed disconnected from the company's real estate inventory value. Now, with the stock shooting up, the mood has shifted to one of triumphant disbelief and excitement. Social media is alive with discussions about diamond hands and crushing the shorts, turning the trade into a moral victory over hedge funds and perceived Wall Street cynicism. The options market reflects this retail mania. The latest data shows a massive concentration of call option volume with a deeply bullish put-to-call open interest ratio of just $0.24, meaning call buying is heavily outweighing put buying, which is a classic signal of speculative retail exuberance driving prices higher. Retail is excited about the new CEO's aggressive stance, viewing it as a clear signal that the company is finally fighting back against the short thesis, framing the entire movement as a battle of wills rather than a battle of financial ratios. Opendoor's core business model is centered on being a technology-enabled platform for residential real estate, which they call iBuying or instant buying. The company essentially uses a proprietary, data-driven pricing model to make cash offers to home sellers, buys the home, performs necessary light repairs, and then resells it quickly, collecting a fee on the transaction. The goal is to digitize and simplify the traditionally slow, painful process of selling a house. Their success is determined by three main variables: the speed of inventory turnover, the accuracy of their pricing algorithms to minimize losses on home purchases, and their ability to keep overhead costs low. In Q3, we saw the fallout from the previous cautious strategy. Home purchases dropped dramatically year over year, which led to lower current quarter revenue and the sale of older, less profitable inventory, which hammered their contribution margin down to a razor-thin 2.2%. The new management is aggressively changing this, not just by talking about AI, but by immediately increasing the pace of home acquisitions. They forecast a 35% increase in acquisitions for Q4 2025. This rapid shift in execution is the real catalyst the market is responding to. It is a direct challenge to the idea that they would stay hunkered down during the high-rate environment. Instead, they're signaling a move to aggressively leverage their platform, believing their new AI-driven pricing can navigate the current choppy waters better than the human-driven caution of the past. Moving forward, the expectation versus reality tension will continue to define this stock. The market's expectation is still that the U.S. housing market will remain sluggish due to sustained high mortgage rates, which fundamentally challenges the iBuying model. The reality that could sustain this stock's momentum rests entirely on two major catalysts. First, the actual, quantifiable results of the new AI-driven pricing and operational efficiency, which must begin to show up in improved contribution margins and inventory turnover speed in the Q4 and Q1 reports. And second, the short interest. With short interest so high, any positive news or even market-wide optimism can lead to an outsized price movement as short sellers are forced to cover their positions, which creates a powerful feedback loop. The next major risk event is likely the release of Q4 acquisition numbers and the full Q4 earnings, where the market will demand to see tangible proof that the software and AI company narrative is translating into better unit economics, not just higher sales volume at bad margins. If they show progress toward their target of adjusted net income profitability by the end of 2026, the short thesis breaks entirely. But if they miss, this current excitement will evaporate in panic selling. In the short term, traders will be watching the resistance level near the $10.87 52-week high, as breaking that would signal a powerful confirmation of the reversal. For the long term, investors need to see that the company can generate positive free cash flow, something it has consistently struggled with. The volatility here is a feature, not a bug, attracting a specific type of trader who is betting on crowd psychology and a short squeeze mechanism rather than a traditional fundamental turnaround. I want to know what you think about this tension. Comment below what you believe is more likely to drive Open's price over the next 6 months, a major shift in the U.S. mortgage rate environment, or the psychology and positioning of short sellers and retail traders. Ultimately, the story of Opendoor Technologies, Inc. is a direct study in how perception and positioning can completely override fundamental data, at least temporarily. Expectations coming out of Q3 earnings were for a continued slump and consolidation, given the revenue miss and the broader housing market headwinds. The reality is that the CEO's aggressive narrative pivot, combined with a dangerously high short float, has weaponized retail sentiment, translating a negative earnings report into a spectacular short squeeze-driven price surge.